before we do that, we've got the overbuild that happened in the fiber business in
Yeah, the bubble.
99, 2000. Let's talk a bit about that, because that was obviously a fascinating period that we may or may not be repeating some of the AI stuff right now as well.
Yeah, that was a magical time. You're right. And in fact, it wasn't really looking back. It started in '96, and it lasted all the way through 2000. So there were 48 months or 4 years where anything related to the growth of internet and mobile, and on top of that, of course, there was the emerging market story because they were building communications networks globally, meant everything was going to the moon. I remember that period, but it was really an extended period where if you found a stock, and it could be a random name, but it was doing something interesting, it could go up 5 times or 10 times in a few months. And I remember that at the time I was at Smith Barney, our salespeople were getting so accustomed to like stocks having 300% upside that if you had a buy recommendation on a stock that only had 20% upside, they'd be like, come on, Tom, what kind of stock is this? I can make 20% in a week. And I remembered Smith Barney, we'd have this equity capital markets meeting and trading meeting weekly, and we would really talk about market behavior. And Smith Barney was unique because they had a very big retail operation on top of institutional. But every time there was a market drawdown, we would hear from the ECM desk and the trading desks how much retail came in and bought that dip. So it was a market where investors were buying the market steadily, and it, of course, did ascend eventually parabolically. And people were using margin debt very aggressively. I remembered many stories from Smith Barney about people who, instead of getting mortgages, were just taking margin loans to buy a house. And of course, the stock that they owned would go up, so then the house was free. So that did create a really reinforced period that I think resulted in a bubble. And as much as people kind of harken back and say they've seen it again, in the equity world, it has not been as pervasive, and it's been much shorter. And many people have been too quick to call the top. One of the things that happened in that late 90s period, and you know this, is that it destroyed value investors. They famously really got steamrolled because that style of investing value was really getting crushed by momentum and the reallocation. It was really boomer capital into the stock market. And then, of course, it ran out of steam. I think that will happen again. But to me, people who are saying today is a bubble are calling the top so quickly because it was really 4 years. That's a long time. Like, that's someone starting their career and making managing director or whatever. Like, it's a long time that this bubble was really being created in the 90s.